So let me start by offending the algorithms, offending the gurus and some of the laziest money advice that's been recycled for decades. You don't have an income problem. You don't even have an investing problem. You have a structure problem. Because right now in America, people are doing everything they were told to. They bought the house, they invested, they refinanced, they followed the rules, and somehow they still feel broke. Now, that's not bad luck. That's bad structure. And today, I'm going to give you a breakdown of these 3 Instagram reels that's trending right now that will show you and reveal how money actually works. Now, this is not opinions. It's not politics. It's not hype. This is real money mechanics that's helped myself and many of my clients in the past. This is Millionaire Responds. Let's get started in 3, 2, 1. Let's go.
Who are we? Hey, 7-figure squad. What we go? Run it up, run it up.
All right, let's get started with this first clip. You're about to hear something that sounds smart, sounds disciplined, and sounds responsible. Buy term insurance and invest the difference. And before anyone gets in their feelings, listen carefully. That statement isn't the problem. The interpretation is. This is one of the most misunderstood ideas in personal finance. Quite frankly, it's outdated. So listen closely. Let's take a look at this.
Insurance is not an investment. Let me repeat that. Insurance is not an investment because one of the doors that gets opened to making people invest in insurance and make the wrong decision is by believing that insurance is an investment. It's not. When you give your money to an insurance company, what do you think they do with it? They invest. They buy real estate and they buy stocks and they buy bonds with your money. Why not do that for yourself? Why do we get insurance in the first place? Because we had liabilities, more liabilities than we had income, because you financially could be ruined if that expense comes to you. Buy term and invest the difference. A lot of people talk about that. Separate the insurance needs and then separate the investments. I've used term life insurance for myself, and I'm somebody who's got an 8-figure net worth. Guys, I own 0 permanent life insurance. Why? Because I want all my liquidity. I'm an entrepreneur, to go back into my businesses. And by not paying thousands and thousands of dollars a month to an insurance company, I'm able to free up that money to invest back into my business.
All right, pause. First, let me say this clearly so nobody clips me out of context. Insurance is not an investment. Let me repeat that because clarity matters. Insurance is not an investment. Congratulations, buddy. I agree with that. In the moment someone believes insurance is an investment, that's when bad decisions get made. So on that point, we actually agree. Now, here's where I think the podcast host may not fully understand a tool. Why? By the way, here's my policies. I've got 12 life insurance policies. Some of them are universal life policies. Some of them are whole life policies. Some of them are term insurance policies. Some of them are index universal life policies. Because when he says avoid permanent life insurance because he wants liquidity, that tells me he may not be thinking about one version of permanent insurance and not the entire category. Permanent life insurance is just not whole life. There's universal life, which offers more flexibility. Then there's index universal life, which gives you upside potential indirectly linked to the S&P 500 with none of the downside and with the flexibility of the universal life chassis. Now, that matters. Here's why. When permanent life insurance is designed correctly, it can be liquid. Cash value access, policy loans, nor forced liquidation. In fact, one of our professional athletes, we just did a withdrawal from his policies, loan from his policy, so he can invest in real estate from the cash value he put into his policy 3 years ago. So when somebody says, I don't want permanent life insurance because I need liquidity for my businesses, my response is simple. It's not a permanent life insurance problem. It's a design and understanding and a structure problem. And this is when the conversation actually gets interesting. Not agreement, structure. You'll hear people say, buy term and invest the difference. And listen, that's not evil advice. That's just incomplete advice. And quite frankly, I think it's outdated advice because entrepreneurs don't think in binaries. We think in systems. Liquidity matters. Control matters. Predictability matters. And when properly structured permanent life insurance, when designed correctly, yes, designed correctly, I would repeat that over and over and over and over again, designed correctly, it is liquid, it is systematic, and it is predictable. Not to replace investing, but to support most aggressive financial decisions that you want to make elsewhere, like your business. So this is exactly why I've got some upcoming conversations on my Just Earn It podcast. I'm sitting down with real insurance strategists, people who design this stuff at a high level. Douglas Andrew, Marvin Mitchell. This is no hype. This is no sound bites. We just had a real conversation using real case studies and real trade-offs for doing so. So if you want in-depth conversations instead of debates, Stay posted for that and subscribe to my YouTube channel, the Just Earn It podcast. We'll put the link right here. Now, this next clip fits perfectly into my best-selling book, Keep the Keys. It's a conversation that stirs from real estate investors, from homeowners, from the Keep the Keys conversation, because this is the reality a lot of people don't want to think about. Being house rich and cash poor. Whether it's your primary residence or 10 properties or 20 properties or 40 rental properties, equity trapped inside property is still trapped illiquid equity. His brother's saying right here, influencers want to say out loud, some of you guys know what I'm talking about. Okay? Some of you guys know that noise comes from the real estate investor community. So I think it's a valid real estate strategy, but they call it for a reason. So let's take a look at this.
We're going to have the real conversation about buying real estate and whether you can really get rich buying single families, duplexes, quads. I'm talking about really living off of your cash flow, not having other businesses and other active income streams. No, literally living off of the passive income, the dream that we've been sold. And I'm speaking from my real experience and my humble opinion because maybe I did something wrong. And somebody can let me know in the comments whether I did something wrong. But I personally had 40 plus properties and was still broke. Like I was cash poor, equity rich. I had net worth and all this stuff on paper, but I wasn't able to live off of my cash flow if I didn't have other active income streams. At the end of the year, when I look at my P&L, I'm negative or breaking even. Yes, I make cash flow month by month, but by month 7 or 8, when there's a snowstorm and the pipes freeze and they burst and I got to replace the piping and I got to replace the ceiling tiles and the flooring. Let's not talk about when the roof is leaking and we got to keep spending money to patch things up and make things work until we finally got to put a new roof on. Or when a tenant moves out and now you have to replace the kitchen, the bathroom, new floors because they destroyed your unit. You spend $10,000, $15,000 to turn over a unit and then you rent out that unit for $2,000 a month. How long does it take you to get your money back? I'm talking about pure cash flow. Let's not talk about the equity, the net worth, because you only get that when you sell it. And if you refi, it's really just debt that you are borrowing against and then your mortgage goes up. So the dream that we've been sold about getting rich and living a life off of passive income in real estate, I personally didn't live it. I was sold that idea and I learned the hard way. Fortunately, I was able to bounce back, sell my assets, and go buy businesses that cash flow, right? I got into the self-storage business because it has the best of both worlds, where you get the real estate appreciation, the tax advantages, depreciation, but you get cash flow from a business that you actually could drive revenue from every single day with different sales strategies and implementation. So I don't know. Maybe I'm thinking about it differently. That's why I'm having this conversation, for us to really just talk about it. It's not, oh, I'm right, you wrong. I'm speaking from my true experience and my humble opinion. So let me know in the comments, family, when can we have this real conversation about whether you could really get rich off of buying just real estate alone, or maybe I did some wrong.
Salute. Now, this guy is not a hater. This is not someone who failed. This is someone who did what they were told. They followed that process of buying single-family homes, buying duplex, buying quads, living off of passive income. And what did he just say? 40 plus properties and he still felt broke? That reminds me of my Keep the Keys book tour in Sacramento when a guy told me, I got 80 doors. I got $40 million of real estate. I still feel trapped. And guess what? Found out after 26 years of been investing in real estate, he didn't have any life insurance either. See, this is one of the core principles in my best-selling book, Keep the Keys. Equity looks good on paper, but net worth looks great also on Instagram. Cash flow, bottom line, is what feeds your family. And equity doesn't pay bills unless you sell the asset, refinance the asset, or borrow against the asset. And every one of those comes with friction, comes with taxes, comes with debt or risk. And listen to what he's describing. Snowstorms, burst pipe, roofs, tenant turnover, all that positive cash flow. Now you got to turn back into the property to fix it up. $10,000 to $15,000 just to make a unit rent ready again. Then you rent it out for $2,000 a month. How long does it take just to get back to zero, recoup your losses, or recoup the investment you had baked back into the property? This is the part that never makes it to the reels. And this is personal for me because years ago, before I've built a life insurance agency, I had a fork in the road. I could have become a realtor, which would eventually maybe become a real estate investor, or I could have gotten involved in life insurance. I chose life insurance. I'm so grateful I did, because if you make a mistake in real estate, it can cost you millions. It can cost you lawsuits. It can cost you years to recover. But in my business, in the life insurance business, if I have a bad month or even two, I get a chargeback, I'm negative $1,000 in chargeback, or I get a client that says, no, I just have a poor marketing workshop. I just recover. I keep moving. No negative cash flow, no negative setback, no negative credit report reporting. So let me be crystal clear about this. This is not anti-real estate. This is anti-one income fantasy. Real estate is a great asset class. But most people don't get rich from owning houses, from owning homes. They get rich from businesses that cash flow, systems that produce income, assets that don't require constant capital infusion just to survive. Now, this is where people finally understand why I talk about life insurance and building a life insurance agency the way I do. Not as an investment, but as a cash flow stabilizer. A place where capital stays liquid, it stays predictable, and it stays accessible. That way, you're not forced to sell assets at the wrong time, or you're forced to refinance into higher debt just to survive. And this is why I didn't just build a book of business. I built an insurance agency, because there's a difference between selling products and building distribution. There's a reason why people feel stuck in real estate and why some of the most overlooked wealth builders are sitting inside the life insurance industry. And that's a conversation most people never get into. Okay, so this next reel, our final reel here, is getting a lot of traction in real estate and mortgage circles. And I understand why. But before we get emotional, let's get analytical, because what sounds like great news for one part of the industry can carry serious consequences for homeowners, investors, and the economy. Let's take a look at this clip.
Really the best news that real estate has had since 2020, when rates plummeted to 2%. Trump is buying $200 billion worth of mortgage bonds, and the market is already reacting like crazy, up 28 basis points, and the 10-year is starting to fall. That means mortgage rates are about to crumble. If the 10-year goes under 4%, you're going to see mortgage rates on VA and FHA creep into the 4s. This is a huge, huge, huge move. So if you're sitting at a rate that's over like 5.25%, you're about to be ready to refi, and you need to comment low rate below so we can get a hold of you and get that rate and payment down.
Now, from the perspective of a loan officer, a realtor, I get the excitement. Lower rates usually mean more buyers, more refinance, more transaction, more business, because these guys have been having a hard time the last 3-4 years with mortgage interest rates so high. So yes, short term, this can help housing for sure. That part isn't wrong. But here's where I zoom out. This reel is coming from someone whose income depends on rates dropping as a mortgage professional or a realtor. So let's ask better questions. Is this good for Americans overall? Is this sustainable? Is Trump really doing the right thing? And what does history tell us? Because we've seen this movie before. In 2007, 2008, 2009, the government aggressively supported mortgage-backed securities, just like what you see right there. That period led to the Great Recession, the worst economic collapse since the Great Depression of the 1930s. Now, I'm not saying this exactly the same. It's the same scenario. But when the government buys hundreds of billions of dollars of mortgage bonds, we should at least pause and ask why and what comes next. Because here's some pros and cons to this. Here's some pros. And let's be fair. Bond buying by the government can push rates down. It can increase affordability on paper. It can stimulate short-term demand. That's real. More mortgage programs open up and more real estate purchases can be had. That's true. Here's the con. The other side to this is when rates are pushed down artificially without fixing supply, without fixing wage growth, or fixing people's cash flow, home prices rise, and we create more house-rich, cash-poor Americans trapped up in their property because equity looks great, payments feel lighter, but long-term risk goes right up. Again, this is exactly why I wrote the book, Keep the Keys, and why it's number one in real estate investing, why it's number one in mortgages, why it's number one in buying and selling homes. I'm not even in the real estate mortgage business. I'm in the insurance business. Because refinancing into lower rates doesn't solve cash flow fragility, emergency liquidity, or long-term stability. It just kicks the can down the road. And if values rise faster than income, you don't get richer, you get more exposed. You see, equity isn't money unless you sell or you borrow against it. And borrowing against inflated equity just increases leverage. So while this might help some people short term, it doesn't automatically make them financially stronger. And this is why realtors and loan officers just have to evolve. The future isn't just in transactions. It's helping clients manage cash flow, their financial needs in between closings. And you as a real estate professional or you as a loan officer who give them access to one of the greatest assets and greatest liabilities in their entire life, you help your clients and homeowners understand risk And you help them integrate financial strategies beyond the mortgage and beyond the real estate transaction. What does that include? That includes education around life insurance, not as an investment, but as a stability tool. Because one thing to get the keys, it's another thing for your homeowners to help them keep the keys. So here's the real question. Are you building net worth, or are you building cash flow that actually gives you freedom? Now, if this hits you, type the word structure in the comment section below. If you want to understand how to stop being house rich and cash poor, grab your copy of Keep the Keys. We'll put this QR code so you can scan it. At the very least, get 2 free tools from my website, keepthekeysbook.com, your Clarity scorecard, and your Keep the Keys scorecard. Figure this stuff out on me for free. And if you're a professional who wants to learn how this fits into a bigger ecosystem for your business, stay close. This is Millionaire Responds. Make sure you subscribe to our YouTube channel, smash that like button, and drop your biggest takeaways in the comment section below. Appreciate you tuning in to Millionaire Responds episode. And until we meet again, continue to live smart, continue to love smart, and be mighty smart today.